Hey everyone, Chris and Jason here with the Private Lenders Podcast. This will also be posted if you prefer video format in hardmoneymastermind.com. If you're not a member already, go create a free account, join the conversation with us and other private and hard money lenders. Okay, so today we're talking about some things that are happening in the industry, some changes, some recent stuff we've been seeing just in the past month or so, right? And one of those things we want to talk about that has driven some more deals our way. And if you know anything about our system, you know that we lend all private capital. We do our own internal valuations. We only lend in our home markets. And a lot of people in the industry, a lot of competitors and bigger companies don't do any of those things. And we're going to talk about some of the changes that we've seen just recently.
Yeah, it's interesting. We typically kind of go back and forth depending on our loan volume, how many loans we've closed, how many applications that we get in on a regular basis. If it's some sort of anomaly or it's just like ebb and flows, and typically that's the case, right? There's nothing crazy. It just happens that our conversion rate's just higher, right? From month in and month out, and that's how it's kind of always been forever, right? You do kind of a low month and you do a much higher month or whatever, and at the end of the year you look at like your trend 12 months and it's pretty consistent. So again, some of these things that come up recently, I don't know if it's a trend, but it's definitely something that we've seen over and over and over. And a buddy of ours, so I would say this came from three separate sources. A buddy of ours that's a mortgage broker, and then two other people that we know are kind of in institutional back lending, is they're claiming that they haven't, in the last 30 days, because institutional back lenders need appraisals. In the last 30 days, an appraisal had not come in at what the target after repair value was, which was interesting to me. Obviously, these institutional back lenders need appraisals. That's the way that they operate. The appraisal process is a real big pain in the ass, to be honest with you, and that's what it makes it a big headache for a lot of these institutional back lenders to begin with, right? Because appraisers are backed up, they're pain to coordinate with. They have trouble getting inside. A few months back, I remember somebody telling me that their appraisal process was a 2-week backup, meaning that they couldn't even do anything until the appraiser went into the property, right? And that was 2 weeks backed up, right? So imagine you can't close quickly. And that none of that stuff, I really I understand it all. But the interesting part was, this past few days, when they said in the last 30 days, they have not had one appraisal that came in at the targeted ARV. And that's what kind of was the wake up call and got us thinking about some of these other things.
Yeah. So let's talk a little bit about what happens in a transaction when that occurs. And then let's touch on the market too. Okay. So like Jason started to explain, and I'll just go into a little more detail on that. When you do a loan, you're a borrower doing a rehab deal, for example, with an institutional back lender, they will take all the information, have this target appraisal, like, okay, we think that they're going to have an ARV of 240. And I'm using that just because there's a 240 example that came up recently, right? And they base their loan amount, whatever percentage you're doing, 70% of that, minus construction, like that whole thing, based on that 240. Now, mind you, the lender has no clue themselves what the actual after repair value will be. They don't do comps. They don't know. They don't, in all likelihood, they don't live and operate in the area. They don't know what that's supposed to be. They're like, okay, we're targeting 240. We'll go do an appraisal and we'll see what it comes back at. When it comes back low, they then lower their loan amount. Well, there's a couple things that could happen. One, they could lower their loan amount based on whatever their LTV needs to be, which completely changes the deals that the borrower changes the numbers that the borrower thought they were getting into, right? And maybe that works for them. Maybe it doesn't, what that loan amount comes out to be. Or what we've seen recently, or what we've heard from people, is that institutional lender will kill the deal because based on that ARV, they're not going to profit enough and they'll turn down the deal entirely. So in either scenario, oftentimes a borrower who has a plan A and plan B, maybe that was their plan A, we're their plan B, no problem there, will give us a call and be like, here's a situation, what can you do?
Yep. Yeah, that's right. And that's common. I mean, you're dealing with an institutional back lender if you're getting an appraisal, right? A bank appraisal. Right. It's ludicrous, right? Like it's back years back being in the mortgage business. Like that's all it is. It's crazy that's the case. When you're lending out money to a real estate investor on an asset that has a lot of moving pieces, right? There's a construction component to it. There's just a lot of moving pieces. Like this business model is not based on some sort of banking credit based system like a typical homeowner mortgage, right? I understand the basis of underwriting for that. But when you're doing fix and flip loans, I could flip a house, Chris could flip a house, everybody listening could flip a house, but I flip for different prices based on our experience, based on our background, based on what we think we want to put into it, right? You could put $10,000 into it, $50,000 into it, $100,000 into it, right? It depends. There's so many moving pieces. So the whole, obviously you can tell we've never been a fan of this institutional back, and we think it's kind of crazy. But the purpose of this video is obviously to understand kind of what's out there right now and how these institutional back lenders, by having these kind of ludicrous processes, could actually be helping us as well, right? Because the client is not happy if an appraisal comes in under market value, right? And then all of a sudden, they're expecting to get a loan, in this case, let's say $150,000, and expecting to bring a certain amount of money to the table. And then they come back low and they're like, okay, well now instead of you bringing $30,000 to the table, you're bringing $50,000 to the table. That's best case scenario. Worst case scenario is, well, we do an affordability, not affordability, whatever they call it, a profit study, or I don't know what it's called, a profit study. And now we see you're not actually making any money based on $200,000 after repair value. So we're just going to kill the deal completely. And you're going to lose your earnest money deposit and whatever the other ramifications. So it's crazy. And it's not even just, the appraisal side of it is one side. There's also a lot of other requirements that some of these lenders have put in place. And I understand why they put them in place, right? Like when you do massive volume, like a bank, you have to put protocols in place, you put requirements in place, right? There's, if you're a private lender listening to this, and let's say you're looking to do 1 or 2 deals a month, or, like us, 20 deals a month, like we have flexibility. We know all of our deals. We know all of our borrowers. We don't have a strict requirement of, hey, your credit score came in at 659 instead of 660, deal's dead. It doesn't work like that.
Right. Yeah. So, and part of the benefits that come from this, obviously, that we've been alluding to a little bit, is that we've been getting deal after deal, a couple a week recently from these turndowns, right? And a lot of these, like I was saying before about the plan A, plan B, a lot of pro flippers and real estate investors, they have different sources. They know what they can do in different situations. And we've been benefiting from these turndowns and changes and everything else. And the reason why I use that number of 240 ARV before is because that's exactly what happened with the broker who we're pretty close with, brought a deal to Jason, right? And you quoted it based on a 200 ARV. Is that right? And then
we quoted 125. He didn't want to go with us because he needed a lot more money. He was like, yeah, it's worth 245. So they got an appraisal. They went in processing and underwriting with the bank, right? Because the bank doesn't know. It's like, oh, you think it's 245? We'll go off 245. They lent them 40, they proposed to lend them $40,000, $50,000 higher than us. And, 2-3 weeks later, they can get turned down.
Yeah. And the appraisal came back at 200, which is what we quoted it at originally as an ARV. And so, like, my guess as to what's happening here, and pretty educated guess, because we, keep an eye on things, the market, everything else, is that, okay, things have cooled a little bit. Not a lot, hasn't stopped. There's still a lot of buyer and seller activity, without a doubt, appreciation for sure, but not as crazy as it has been in the past 9-10 months. So I think that what's happening, and I'm speculating a little bit here, is that appraisers were saying, okay, we see what's going on with these sales and appreciation, and it's pretty crazy over the past 10 months or so. We'll give you your number, right? You want 245? Maybe it's not there with comps right now, but it could be next month. We'll give you your 245. And they feel comfortable with that because they saw in which direction the market was headed. But now maybe they're not comfortable saying, we're going to give you this inflated value. We're not going to give you your 245. We don't see this lasting forever. Here's what we really think it is. Right? Which changes everything for some of these. And we've been seeing it for years. They're appraisal value, some of these lenders, their ARVs and their loan amounts are way too high. Yeah. Like straight up. And it's even crazier when you get to higher price points. Like in DC, for example, we'll quote 425 and they'll get 550 from some institutional lender, which is like, that's a crazy amount of spread. And it's been going on for a while. And not to say that's coming to a halt, but there are changes. There are changes we wanted to report to you guys.
And the exciting part that I heard that was exciting part to us, obviously, it sucks that this bar turned down, from them. And we're not even sure if we're even doing this deal again. They reached back out to us. That's how I know the story, but they going to try to go to another institutional lender and get another appraisal. But the exciting part to us is the appraisers are being realistic on some of these things. So many people were pushing to 110 or 120 or 130% of ARV, and they were getting appraisals to back it up, right? So I was excited that the appraiser appraised at what we thought was the fair market value, because then all of a sudden we're in the playing field. Like you're never gonna win a deal. Typically, even if your prices are comparable, you're still not going to win a deal if another lender is going to lend $20,000 or $30,000 more to somebody else. Like that's what it comes down to. So a few other things real quick that we've seen, or just keep these in mind. Some of these have been going on for a while. Just keep these in mind because you can use it as a selling proposition. Is make sure when you're talking to your borrower up front, your client up front, that they know that if they go with an institutional backed lender, it's going to be a longer process. They're going to have to get an appraisal. It could take time to do that. Educate them to make sure they understand. If you're doing a loan, let's say you're doing a sight unseen auction property loan, and you can't get inside the house, there's no way an institutional lender is doing that deal. If you can't get them into the house, let's say your borrower has been inside the house, but they have some pictures, but they're having a hard time getting in. There's no way an institutional lender will ever do that because they can't get into the house, right? Now, don't get me wrong. That's a little bit more of an advanced loan. It might not be for a new or a newer, hard money lender to fund a loan like that, but there's always a number that still works, right? A lot of investors, hard money lenders have in their mind that's like, I have to lend up to 65%. No, you don't. You can lend 10% LTV if you want to. So for instance, you're lending locally, right? If you're following the right formula, you're lending locally, the areas, you have additional resources in the area. Let's say there's a property that they're buying at auction. It's sight unseen. You can't get in the house. Well, you can still use an educated guess to see approximately what you think the property's worth, what the estimate construction costs are. Is it an experienced investor? Do they have a lot of cash? If it's an experienced investor, they have a lot of cash, you write them a slightly lower LTV loan because there is some unknowns because you can't get into the property. Chances are it's still a very good loan to write, right? And these are common. These happen all the time. An experienced investor comes to us. They're buying a property for $200,000. They're estimated $50,000 worth of work because they've peeped through the windows. It looks, it's vacant. They just can't get inside because it's an auction property. They think the resales, whatever, 375, 400. If all that sounds reasonable, maybe you lower your exposure a little bit. You lower your loan amount. You make them bring a little bit more cash to close just in case. And typically a deal like that works out fine. But if you understand kind of what these institutional bankers and these appraisers need, you can kind of sell against them and work against them on this. So, and let me follow up with one last thing that I've realized. It actually is helpful to us when our clients reach out to institutional backed lenders first, because it's less that we have to sell. They go through that process. They realize it's a pain in the neck. They realize they need at least 20% down anyway. They realize what the time frame is. They realize that they need this potential credit score. By the time they come to us, right? They're like, hey, everyone I've called requires this, and this. This is the situation. Like the expectations are already set, right?
Yeah, they're set high too.
That's right. So, and I love when that happens. I got a call from a guy earlier this week that this is a really unique situation, so I don't want to bore you with it. But in essence, he was like, I've talked to 5 other lenders already. This is my challenge that I'm coming up with. No one can do it. I'm assuming you can't either. And I was like, honestly, this is a no-brainer. he was buying, in essence, what was happening is he was buying a property from a family member that she was collecting all the money kind of on the back end, nothing on the front end, right? So he's getting a property for next to nothing that had a $400,000 ARV and $100,000 construction budget. And he had a lot of the money. He just needed like $50,000 or $60,000. So in essence, and again, this is a little complicated. It's kind of like a cash out purchase, but in essence, we're doing a $50,000 loan for this guy. And it was a no-brainer. And he was like, how can you do this? I was like, we're not a bank. We're a private lender. It makes sense. It's a collateral-based loan. And he's like, because all these other guys, I had to put down 20%. I had to do this. I had to do that. And I mean, this guy has 700 plus credit. He's got multiple other assets. So we've got a lot of stories like that. But the point is, be creative and, have these institutional lenders, kind of muck it up with their red tape, and then you can be the hero.
Absolutely. I mean, there's a lot of opportunities out there if you know what you're doing and you're set up right, and like you control your capital and you do your valuations and like you have control of your operation. It's not all about price, guys. Like it's really not. Like you can land at the double-digit interest rates and all the traditional sort of hard money stuff if you're set up properly. Yeah. Anything else to add on that? I think there's going to be some more changes to come here throughout the fall. We'll make sure to be reporting back on the podcast and in the mastermind. Like I mentioned before, feel free to go anytime and create a free account at hardmoneymastermind.com. Introduce yourself. We're in there. The other members are there. We're talking hard money and private money stuff every day, raising capital, underwriting, the whole nine. In addition, if you ever want to check out our lending company and see how we do things and how we market and just what the whole presentation of our brand and company looks like, check out hardmoneybankers.com.
Absolutely, guys. Hopefully you enjoyed, and we'll see you guys